Hey, it's Richard with Matthews Wealth Management, covering the numbers from June 2022. It's all red. I have a black pen here just to outline categories and make some notes, but everything sucks. So let's cover equities first, U.S. stocks, right? So we're talking large companies, mid-sized companies, small companies, value, blend, and growth. If you don't know what that means, go watch some more videos or do some research. Anyway, horrendous, right? Everything down, down, down. And it's interesting. You've got a negative 682. That, I mean, if you don't count the small growth, you go from 6 to 1111, but you go from 976 or 107, I mean, however you want to round here. They're inverted on best and worst on the value versus growth on the size of the companies. That's strange. You don't see it all the time. I think we saw something similar 2 months ago, but it's just a time of bubbles bursting, right? Things are restructuring in the face of lots of uncertainty, regulatory uncertainty, tax uncertainty, interest rate, balance sheet, money supply, blah, 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 right? This is what intervention creates. So if we don't like this, let's get rid of the intervention. Wow. International and emerging down 9 and 6. Surprising. Actually figured it'd be flip-flopped, that emerging would do poorly. However, we talked in our commentary or rant video here about Augustine Karsten and what he had to say about emerging markets and how they manage their economy. Very differently, I should say, from developed markets in the sense that they care about supply of their economy, not just demand. We might want to look into that. Although we're developed, so we know we don't have to look at supply, or we can forget about supply until it rears its ugly head. Bonds continued their dive. Short-term bonds down 70 basis points. Intermediate term bonds down 1.1. Long-terms down another 3. Tips down another 3. High yields down 6.73. Cool, we got out of all this. If you saw a reallocation video, if you're a client and you get the newsletter, then you definitely got the reallocation video. And we went to cash because bonds are not, there's no safety in bonds and interest rate risk world. Real estate continues its sell-off. I think it's down like 21 year to date. I don't think it's close. I think it's got another 20 or so to go. It's a nice slow decline at least. You give that to real estate. They don't have the big bubble bursting like they did in 08 through 10. Oil, surprisingly, down for the first time in a while. Actually, I don't know. We had one random down month at one point, but down 5. That's a lot. That's a big downside here. Gold down another 2. So anyway, it is what it is. For the month of June, Nasdaq dropped about 10%. S&P dropped a little over 8. A moderate stock bond portfolio dropped 5.71. And our practice dropped 5.78. That's annoying, but whatever. We're preserving assets is the best you can do in a time like this. I got into an argument with the client saying, what do you want me to do? All cash? Tell me when to buy back in. You can't answer that question, so that's why we don't abandon completely. We play the long game of outpacing gains and minimizing losses because you can't avoid them. So anyway, I wanted to point out the first half of 2022, the worst stock loss since 1962. Wow. We are down 21.22% all stocks across the first half of this year. Nice, it's got a 22 in it, right? It's irony, I guess. The worst bond loss ever. Ever. Bonds aren't safe. Interest rate risk. Worst crypto loss ever. So if you were in stocks, you lost 21%. If you were in bonds, you lost 21%. If you were in Bitcoin, you lost 59%. I think it was Ethereum down 73%. Oil in the first half was up 40%, which is the best since last year. It's another 40% last year. So commodity prices, inflation, duh. This is astounding. This is just unbelievable. Global wealth, right? If we just measured the value of assets in store, dropped $31 trillion. Trillion. Like that's lots of zeros, right? More zeros than you're probably thinking just evaporated. The dollars still exist, but the value's not there. Uh-oh. That's the problem with printing, right? It's this false sense of value, and now it's starting to get restructured here. Fed's still sitting on the 8.9 trillion. It created more money in the M2 money supply last month, so we're up again on that, creating more inflation. So even with just barely thinking about doing something about this runaway rampant inflation, the fear of recession is so big right now that it still lost 31 trillion and they hadn't even done anything. Yeah, I don't know. Selling all to cash, it seems kind of interesting. The value of the dollar has gone up in relation to what? Not assets, but in relation to other currencies, it's gone up just because they're going to pay some interest on it, as long as they keep raising rates. But yeah, great job, Fed. Y'all have put yourselves in this position, and I wish people wouldn't let you squirm your way out, but you'll likely get away with some little talk and threading the needle of destroying the West. I mean, as long as we don't get destroyed first, right? Europe's got to go first, and I think that's more likely. So anyway, I won't continue the rant. This is supposed to be just numbers, but nothing's up, and we're not surprised. We'll stick around and see what happens throughout the month of July.